In this webinar, we cover adjustments to income for self-employed taxpayers. The first deduction we're going to cover is the deductible part of the self-employment tax. Self-employed people have to pay both halves of the Social Security and Medicare tax. That's what the self-employment tax is, or the SE tax that self-employed taxpayers have to pay. When you're working for a company as an employee and you're getting wages on a W-2, the employer pays half of the Social Security and the Medicare, and the employee pays the other half. They split it. But when you're self-employed, you don't have anybody else to pay that other half for you. So you have to pay both halves. You have to pay all of your Social Security and all of your Medicare tax. And that goes into your Social Security fund, those taxes, so that you can claim Social Security and Medicare once you turn 65. That's what those taxes are for. In addition to self-employment tax, you have to pay income tax when you're self-employed. But the self-employment tax is all on you when you have a business. Now, in order to make it a little bit more fair for self-employed people, the IRS allows you to deduct 1/2 of your self-employment tax as an adjustment to income when you are self-employed. It's the equivalent almost to the deduction that a business would get, because a business that has employees is allowed to deduct the half of the payroll tax and the Medicare taxes that they pay on behalf of employees. That's a business deduction on like a corporation or a partnership's tax return. When they have employees and they're paying that Social Security and Medicare tax, they get to deduct it. The business gets to deduct it. So self-employed taxpayers get to deduct it too. It's treated as an adjustment to income on Schedule 1. And your software does all of this automatically, which is why I'm explaining it so much. Most people who are newer preparers, they don't pay attention to this because the software does it. But it shows up on the Schedule 1, and that number, the deductible part of the self-employment tax, is 1/2 of their self-employment tax. It's basically the amount that would be deductible by a business if it was a business paying wages to employees. When you're self-employed, you're not an employee. You're working for yourself. So you have to pay all of the self-employment tax yourself. But you can take half of the self-employment tax as an AGI adjustment on Schedule 1. And like I said, your software does all of this for you. I just want you to realize for the test, if they ask you a question about this on the exam, it's not a deduction that's taken on the Schedule C when you're self-employed. It's an AGI adjustment on the Schedule 1. Now, if you have a self-employed taxpayer that is kind of in the higher income thresholds and they have to pay the additional Medicare tax, they cannot deduct 1/2 of the additional Medicare tax on their earned income. The additional Medicare tax kicks in at higher income thresholds. And I'm going to talk about the additional Medicare tax in a later webinar. It's an ACA tax. This is one of the taxes that was instituted by Congress to fund the Affordable Care Act. You can't deduct 1/2 of the additional Medicare tax as an adjustment to income. Congress calls it the additional Medicare tax, but it doesn't function like regular Medicare tax. You don't get to deduct 1/2 of that one. The additional Medicare tax is just something that Congress decided to name it, and Congress put lipstick on a pig. They put a ball gown on this tax by calling it the additional Medicare tax. But it doesn't really function like a Medicare tax. Congress can call it whatever they want, but you don't get to deduct the additional Medicare tax when you're paying it. You don't get to deduct 1/2 of it if you end up getting stuck paying additional Medicare tax and you're self-employed. It doesn't function like regular Medicare. You have to pay it, but you don't get to deduct 1/2 of it. You just have to pay it and that's it. Self-employed SEP, simple and qualified plans. When a taxpayer is self-employed, they have access to some of the same kinds of retirement plans that are utilized by larger employers. Self-employed individuals can deduct contributions to the following types of retirement plans. The simplified employee pension. This first one, is the most popular type of plan that self-employed taxpayers have. If they have a successful business on Schedule C and they're self-employed, then the SEP is the most popular type of plan for that type of individual. And that's because the SEP doesn't cost anything to set up. You have a lot larger retirement plan contribution limits than you do with like a traditional IRA, for example. You can put a lot more money into a SEP, but they're free to set up most of the time. Like, for example, my financial institution doesn't charge anything to set up a SEP. And it doesn't have any kind of special reporting requirements. Like you don't have to file a return for the retirement plan itself. And some of these other plans you do. So the simplified employee pension is by far the most popular when you have a self-employed person. They can also set up a savings incentive match plan for employees. That's called a simple plan. And then they can even set up a qualified plan. Qualified plans are expensive to administer though, and they cost money to set up. So most of the time when you have a self-employed person, they don't set up qualified plans unless they're making huge amounts of money. And by huge, I'm talking like 6 figures or more. They generally will not set up a qualified plan because these cost a lot more money to set up. But if you have someone who has a very, very profitable business, sometimes they'll set up one of these other two here at the bottom. But usually it's a set. This deduction for these types of plans, when you are a self-employed person, this deduction does not go on the Schedule C. If you're making a contribution for yourself and you're the business owner, the deduction does not go on the Schedule C. It goes on the Schedule 1 and it's an adjustment to income. Just like the deduction for a traditional IRA contribution, that's also an adjustment to income. But these are separate lines. If you have a self-employed person and they have one of these plans for their business, that's a different line than the deduction for an IRA contribution. And it doesn't go on the Schedule C. The only time you would put a contribution to one of these plans on the Schedule C if you were self-employed is if you were making that contribution on behalf of an employee. And then you take the deduction on the Schedule C. But if it's a contribution to one of these plans and you're making it for yourself, then that's an adjustment to income. A taxpayer must have self-employment income in order to contribute to his or her own plan. If it's the business owner, you have to actually show a profit on the Schedule C in order to make a retirement plan contribution. However, if you are a self-employed taxpayer and you do not have a profit on the Schedule C, you can still contribute to an employee's retirement plan. So for example, if you have an employee working for your business and your business shows a loss for the year, you can contribute to the employee's plan. And it can create a business loss, like a net operating loss for your business for that year. And that's okay. Just like you can deduct wages for an employee and it will create a loss for your business. That's fine. But you have to show profit on the Schedule C if you're self-employed if you want to contribute to your own retirement plan. Example, Ricardo is a self-employed kickboxing instructor. He has a full-time receptionist named Dana who works in his training gym. During the year, Ricardo makes a large fitness equipment purchase for his training gym. The fitness equipment qualifies for Section 179 and bonus depreciation. Ricardo claims Section 179 depreciation on all of the equipment and reduces his taxable income down to 0 for the year. Now this, in my opinion, is really bad tax planning. Well, like, why would you do this? Why would you reduce your taxable income down to 0 for the year on your Schedule C and not be able to make a retirement plan contribution and not pay even just a little bit of self-employment tax in order to fund your Social Security and Medicare? This is bad tax planning. But of course he can do this. He can take Section 179 and reduce your taxable income down to 0 for the year on the Schedule C. So you have 0 taxable income on the Schedule C. If he does this, though, he cannot contribute to his own retirement plan because he has no taxable income on his Schedule C. However, Ricardo is still allowed to contribute to Dana's retirement plan. This is true even if there is a loss on his Schedule C. If you have a business owner and they have a SEP, for example, that's the most common type of retirement plan. When it's a business retirement plan and they're self-employed, usually they'll set up a SEP. When you have a business owner and they have a SEP, you have to set up a retirement account for your employees. The employees cannot decline. And I talk a lot more about this in part 2. In part 2, we go over business retirement plans at length. I have a webinar dedicated just to that topic. And I do recommend that you listen to that webinar when you get there. It's very complicated. But if you do have a business owner and they have a SEP set up for their business, then if they have losses, they cannot contribute to their own SEP. But they can still contribute to the SEP for the employees. And that's just a business deduction on the Schedule C. And if they have no income for the year on the Schedule C, then it will generate a loss for the business. And that's how it's treated. The self-employed health insurance deduction. This is once again an additional line to the other two that I just discussed on the Schedule 1. And this is just for taxpayers who are self-employed and are paying for their own insurance, their own health insurance. A self-employed taxpayer may be able to deduct 100% of their health insurance premiums as an adjustment to income as long as the business has profits for the year. This number used to be lower, or this percentage used to be lower. Many years ago, it was only 50%. And then enough people complained to their representatives that Congress changed it. They changed it to 100%. So you can deduct 100% of your health insurance premiums, but not on the Schedule C once again. If you're self-employed, it's an adjustment to income. Premiums paid by the taxpayer for a spouse and dependents under the age of 27 are also deductible. The deduction is limited to the net profits from the business. So if the business does not have any profits, you cannot take this deduction for yourself. This is another reason why sometimes it's really good to, pull back on that depreciation and not take Section 179 or bonus depreciation so that you can show a little bit of income on the Schedule C. Because if you don't, then you're not allowed to take this deduction. And it's essentially lost. Like, you don't get to carry it over to future years because it's not technically a business deduction on the Schedule C. If there's self-employed health insurance premiums, the self-employed business owner is paying for themselves or for a spouse or for a family member, like a child. The reason why I have to make that distinction is because if you have a business owner that has employees, like let's say I hire someone to work in my business and they're an employee of my business, then if I pay health insurance premiums for them, then that is a business expense on the Schedule C because I'm paying the health insurance premiums on behalf of an employee. But if I'm paying health insurance premiums for myself and I'm self-employed, then that deduction does not go on the Schedule C. It's an adjustment to income on the Schedule 1 instead. There's a special line just for this. In order to take this deduction on the Schedule 1, the taxpayer must either be self-employed and have a net profit for the year. They can't be showing losses on their Schedule C in order to take this deduction. They have to be self-employed and have a net profit for the year, or be a partner in a partnership with net earnings from self-employment, or have received wages from an S corporation in which the taxpayer was a more than 2% shareholder. And this one is a little bit weird, the third one on this list, because if you're an employee of an S corporation, you're the owner of that S corporation, and you're also an employee, you're not considered self-employed. You're an employee of that S corporation. But when it comes to the health insurance of an S corporation shareholder, it has to be added to their wages, and then it's deductible this way. For C corporations, it's not like this, but for S corporations, it is. It has to be added to the W-2, and then it's deductible as an adjustment to income. If it's health insurance premiums that are paid on behalf of the shareholder of the S corporation. And, you might think that this is a business topic, and it is, but it affects the taxpayer's individual tax return. This is something that happens on the Form 1040. This is not something that happens on the S corporation tax return or the partnership tax return if it's a partner in a partnership. And we're going to talk about it in part 2 because we have to talk about how the business itself has to report these items when you have a business that's paying the health insurance premiums for a partner or for a shareholder in case of a corporation. But this right here, this affects the taxpayer's individual tax return. So this all is happening on the Form 1040, which is why we have to talk about it here too. But if you have a person who's self-employed, they're allowed to take 100% of their health insurance premiums as an adjustment to income. This deduction applies to all different types of health insurance. So if you have regular health insurance, and then you also have vision and dental or long-term care insurance, that's all insurance. You can lump it all together for the purposes of this deduction. If the taxpayer is actually receiving those other types of insurance, then that's all includable. And you could take the deduction for that types of insurance too. You can also take the deduction for Medicare premiums, amazingly, if it's a person who is over the age of 65 and paying for Medicare premiums. That's deductible too, if they're still self-employed, if they happen to also have a business. A self-employed taxpayer may not take the deduction if either the taxpayer or their spouse is eligible to participate in an employer-sponsored subsidized health insurance plan, even if they decline the coverage. I think that this is really unfair, personally, but this is the way that Congress wrote this into the law. This is in the law. If you have a situation where you have insurance and you really like it and you're self-employed and you're paying for that insurance, and then you are given the opportunity to participate in a subsidized health insurance plan, you have to take that subsidized health insurance plan, even if you don't want to, because then your self-employed health insurance deduction is disallowed if you get an offer of coverage from a subsidized health insurance. Usually this happens when it's a married couple, honestly. So for example, my husband and I are married, and let's say I file a Schedule C for my tax business. I have a tax business and I'm filing a Schedule C and I have profits, and I've been paying for health insurance for maybe even the both of us, right? I've been paying for health insurance, and then he gets a job, a new job, let's say, that offers him health insurance, subsidized health insurance. Let's say it's crappy and I don't want it. I don't want his health insurance that he's getting through his job. Well, I'm happy with the health insurance that I have. But just the fact that we got an offer of coverage for subsidized health insurance, if we get an offer of coverage and we don't take it, even if we continue to pay our own health insurance premiums, we're not allowed to deduct our self-employed health insurance anymore because we got an offer to participate in a subsidized health insurance plan. And even if we didn't take it, we're not allowed to take this deduction anymore. And you might think, oh, well, how would the IRS even know that this happened? And they would know because the employer, when they do offer health insurance to an employee, it gets reported to the IRS on the Form 1095-C. If they give the employee an offer of coverage, like if they offer coverage to them, even if the employee doesn't take it, it shows up on that form. So the IRS knows that you received an offer of coverage. I don't like this, but this is how it is. So if you are paying your self-employed health insurance and you receive an offer of coverage in a subsidized health insurance plan through an employer, usually it's through a spouse. You might have a business and then your spouse goes out, your husband or your wife, they go out and they get a job, and that job offers them health insurance coverage that will also cover you. If you don't take it, if they offer it to you and you don't take it, then you are not allowed to deduct your self-employed health insurance anymore, even if you continue to pay it and even if you decline the coverage. Just the fact that they offered it to you makes it that you can't take this deduction anymore. It's no good, but that's how it is. And let me give you two examples. Example number one, Breton is unmarried and runs his own business as a refrigerator repairman. During the year, he paid health insurance premiums of $3,000, which is $250 per month. After deducting all of his business expenses, his Schedule C shows a profit of $15,500. So he has a profit on his Schedule C. He may deduct the full $3,000 in health insurance as an adjustment to income on Schedule 1 of the Form 1040. Example number two, Heather and Jeremy are married. Jeremy is a self-employed carpenter and pays for his own individual insurance policy. Heather works for a grocery store as a cashier. Jeremy was eligible to participate in a subsidized health plan through his wife's employer, but Jeremy declined the coverage because he didn't want to switch doctors. Jeremy cannot take a deduction for the health insurance premiums that he paid because he declined to participate in his wife's employer-sponsored coverage. So he loses the deduction because he could have participated in his wife's policy through her workplace, and he declined the coverage. He can't take the deduction anymore on the Schedule 1, even if he still was paying his health insurance. Next webinar covers the penalty for early withdrawal.